Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from German taxes to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. You can watch these podcasts on YouTube at youtube.com/Doug McHoney. On this week's episode of Cross-Border Tax Talks, we're at PwC's Global Transfer Pricing Conference in Berlin, Germany, where I'm excited to be joined by Arne Schnitger. Arne is an international tax partner with PwC here in Berlin and co-host of the German tax podcast, oh boy, Arne, Frisch Serviert?
Oh, very close. Frisch Serviert.
Frisch Serviert.
Yes.
I'll let you do the German pronunciations.
Sure.
All right.
Good.
Who you host with Christian Kaiser.
Yes.
So Arne, welcome back to the podcast.
Thank you, Doug. Glad to be here.
You knew I was going to struggle with the German pronunciation.
Yeah. But you're doing good.
Thank you. Don't patronize me. Which the translation of your podcast served fresh.
Correct. Yeah.
All right. I did have to Google that. I think you told me, but
Yes.
I did have to do the translation.
Yeah.
So Arne, believe it or not, it was December 2020 that you were last on the Cross-Border Tax Talks podcast. It was one of the virtual podcasts, which I always prefer, being able to sit with you here in person, and it's awesome to be here in your hometown of Berlin, where we talked about Section 49 of the German tax code. This mysterious provision that appeared from 1925 that applied to foreign royalty payments, where the underlying IP was based in Germany.
Right.
We're going to talk about, I'll tell listeners, at the end of the podcast, I'm going to force you to do an update. I think you have Section 49 fatigue at this point.
A little bit, but that's a cliffhanger, I guess.
It's still that's the cliffhanger to keep people listening to the end, although you can't scroll through these podcasts, as you well know. But it was September of 2022, so just a few weeks ago, that I was honored to join your podcast, where we talked about the book minimum tax.
Right.
Was it the first podcast that you had done in English?
Actually, I think it was the second one.
We had
one with Georg Kofler about Pillar 2 in European law, which we did in English, which was interesting because he's Austrian. So an Austrian and German trying to speak in English. So it's going to be something I don't know. It makes sense. But so it was the second one, and actually was very, very well perceived. People really liked it, actually. People commented on it in German. So
On which podcast?
On yours, basically, On ours, actually.
On ours, well, that's fantastic. And for those listeners that want to check it out, I talked about the book minimum tax.
Right.
And we kind of explained why the book minimum tax is not a QDMTT or Pillar 2, but comparing it to some of the Pillar 2, the Pillar 2 rules. So my first question before we begin, what do you prefer, Arne, being the host or being the guest?
That's a good question, actually. I don't know. Can I answer this after this? I don't know.
You've been on before.
Yeah, actually, you know what? I think it was a lot of fun to be here, and actually it's also fun to be here in the studio. We do our podcast still virtually, and I have to say, this one I really prefer. I mean, I told already you before, maybe you should talk to our German management team, but we need the studio as well.
Right.
Maybe I'm going to enjoy my own podcast even more.
So we're recording today, for those that are actually listening to this and not watching on YouTube, in a hotel, in a conference center here in Berlin, but we do have the cameras set up, and so many listeners, I think, prefer to, and I'm like one of the kind of guys that prefers to watch my podcast as opposed to listen, but that's not always easy to do.
But just to be joking, I think it's really fantastic to be also a host, simply because you meet so many fantastic, people joining the podcast, and I think that's what I really enjoy, even though it's also nice to be here and meet, of course, in person of such a long time, especially.
Well, thank you, and I will tell you that I have a strong preference to host as opposed to be the guest. I feel a lot more pressure as the guest, as opposed to, it's a lot easier to ask the questions. So I'm glad the tables are turned here, and I can be the host and you can be the guest. So what I really wanted to spend some time today talking about, Arne, and we'll get to a couple of the other German topics, I guess, in Section 49, and I also have some questions about your anti-hybrid rules. But really wanted to spend some time on Pillar 2.
Right.
I think the last kind of Pillar 2 podcast that I had on had Callum Dewar, who is one of our international tax partners in the U.S., talking about deals. And I heard a lot of feedback from that podcast because I think the light bulb went on for a lot of people. Like, even though these rules haven't been enacted, they're still in play, right? Because of the transition rules and because of any transactions that have occurred after the date of announcement in December of 2021, this year, even though there's no rules kind of officially law, we're still in play. So I think it's really relevant for taxpayers, advisors, academics that listen to the podcast, really how important Pillar 2 is. And I think what a lot of the naysayers from Pillar 2 that I've talked to, looked at what's happened with the EU directive and the lack of the EU to be able to get unanimity as potential evidence that, Pillar 2 is going to fail. Is this really going to happen?
Right.
And so, a few weeks ago, I think it was in September of 2022, there was a joint statement from Germany, Spain, Italy, and the Netherlands, I might be missing one, about Pillar 2. So tell me about this, because this was really big news. And I think this took many of us by surprise, as there were discussions about enhanced cooperation.
Sure.
But Germany came out, and what did they announce?
Right. Well, basically what they announced, no matter how the discussion will play out on European level, Germany, including those other countries you just mentioned, gonna move forward and just implement those rules. And it's actually interesting because when the statement was published, we of course heard a lot of also requests from the network and also from clients internationally. For us, it was not even such a surprise. And why is that? Well, you might have heard Germany has been a supporter of this initiative for quite some time, and we've been hearing about this development, let's say, for the last 2 or 3 years.
Oh, yeah.
And so therefore, we always expected that Germany, no matter what will happen, will move forward to that, because it's being seen as something which is the right thing to do, creating a level playing field. And therefore, when the statement was made, it's really something which was almost kind of expected. But now, of course, as this is out there, politically, that's a very strong statement, as you can imagine. And therefore, now you can also imagine that I think the works on these rules are, of course, probably getting some speed, getting some traction. We expect also, rules as we hear it, maybe end of this year, maybe first quarter, basically, because if they need to be implemented by 24, there's obviously some time in the legislative process. And as you've also probably seen, a lot of other countries already launched the rules, and now as we're one of the countries supporting that, of course, we don't want to be in a position that suddenly we're lagging behind. So therefore, for us, it was not really so much of a surprise, but I can imagine that outside, if you don't follow it so much, you can see, this is now really a big statement for us.
Yeah, and I think that was kind of one of the maybe misconceptions for some of us that we're so closely tracking what's going on from an EU perspective.
Right.
Maybe some of us lost sight about what's taking place in the specific jurisdictions. And I think it's Germany, Spain, Italy, Netherlands, and France were the five. I think I had missed France.
Yeah.
So you said that you expect rules maybe to come out in the last quarter here of 2022 or the first quarter in 2023. How does the German legislative process work? Because we've spent a lot of time on the cross-border tax talks talking about the U.S. legislative process and the need, because we were expecting big U.S. tax reform, and what we ended up with, as we talked about on your podcast, the book minimum tax. Tell listeners kind of how does that work from a German perspective and kind of the process.
So I have to say it depends a little bit. So as always, it starts with the draft. And the first question, is it a draft just from the ministry or is it a draft already from the government? That's the first question, which we don't know yet. I mean, these rules are quite complicated, as you imagine. So exactly. So I would not be surprised if there might be a first draft from the ministry. And I would also expect that there will be some reconciliation. So how usually it works, especially for those complicated rules, you have drafts which are sent out to different stakeholders, sent out to different organizations.
To give them a chance to comment.
Exactly, to comment on that. And I would expect something similar, of course, as well here. And then basically, ultimately, it will go into first official draft, and then basically it's going to be going through our parliament. Actually, we have two bodies, basically. One, it's the German parliament, then there's one lower house, if you might say so, where the different states have to consent to it as well. And that's then basically the process. And obviously there will be also official hearing where basically also experts will be heard too. And then in Parliament it has to pass as a normal bill and then be enacted basically. And that has to be done during the year, next year basically, in order to be applicable for 2024, which we expect will be the date of application. But of course, that's all to be decided in the process.
Sure. Yeah, and we should caveat that because I'm going to ask you to speculate too a little bit. So you had mentioned kind of effective date. Is it still kind of the view that, and I do think it's kind of interesting that for tax years beginning after or on or after December 31st, 2023, I'm not really aware of many taxpayers whose tax years begin on the last day of the calendar year.
Right.
But I guess that gives, still it's enacted in 2023. So is it your speculation that there would be the income inclusion rule that would apply effectively for 2024 and then the undertaxed payment rule for 2025?
Well, that's the question. So 24, that's the current speculation at least.
Okay.
Again, as said, that's something we don't know. We need to see what the draft law is foreseen. But I mean, so far I would expect it's 24. And then with the undertaxed payment rule, we don't know. So it would make sense to push it a year back. But I would also not be surprised also if it's all in 1 year applicable. So all going on 24.
Interesting.
Also something which could happen. We will see. At least it would provide for a application in a constant manner, in a constant way. So we'll see what the final draft law will say.
Yeah, and as you know, that's very interesting, particularly for U.S. parented groups.
Yeah.
Obviously for German parented groups with the U.S. subsidiary, the income inclusion rule would potentially tax any of those U.S. subsidiaries. But then if you're a U.S. parented group with the German sub and the undertaxed payment rule, and I think one of the things that I've seen as I've looked at a number of companies and a number of different industries, it's been very interesting and surprising to me, frankly, the number of U.S. companies whose globe rate is below 15, primarily driven by the incentive regimes that the U.S. have, which are generally non-refundable business tax credits.
Right. And it's going to be very interesting to see that because, as you say, if Germany sits directly under the US, the question comes up, which we talked in our podcast in German as well. How do we see your book minimum tax? Is it equivalent IIR? And so far as we understand the rules, I think there are some question marks whether we can say that's qualifying IIR. And if those rules would change
for anything that's sitting below the U.S.
Right. So Germany sits below U.S. and we would say because you do, for example, global blending, we wouldn't consider it to be equivalent. Then the interesting question comes up: what does this mean? It would mean we would apply our UTPR under tax profit rule, and if Germany sits directly under the U.S., we would actually tax the profits in the U.S. but also all of the rest of the world.
Right.
Which is kind of something I can't imagine, to be honest, so far. But that's how the rules are actually so far laid out.
Right.
And if it's applicable for 24, that could be very relevant.
Right.
Because then Germany sitting directly under US, that will be the consequence. It will be different though if Germany would be sitting under some other country, one of the European ones you mentioned, and these countries would apply the IIR because then of course we would not apply our UTPR again.
Right.
So but that's very interesting. Also imagine if you have German entities below which are PEs, also that's quite interesting because then changing the structure and changing the legal structure could be a little bit more complicated. So I think that's really something to keep an eye on because the way how the book minimum tax and these Pillar 2 rules work could lead to some very interesting dynamics. Actually.
Oh yeah, absolutely. I mean, and then there's still obviously the uncertainty for those U.S. MNCs, like is how do you treat GILTI? Right. And that tax, right? Because that's almost like the first question before the book minimum tax.
Sure.
Presumably that's a qualifying CFC regime that you would push down the taxes.
Right.
I know there's been a lot of questions and frankly a lot of debate amongst our U.S. tax professionals about, the reason a number of U.S. companies are paying GILTI taxes because of our expense apportionment rules, right? Not necessarily because the subsidiaries, the foreign subs underneath the U.S. are below the 13%-ish GILTI tax. It's because of our, mostly driven by our interest expense apportionment. And then it begs the question, if it's a result of interest expense apportionment that you're paying GILTI, should that tax stay up in the U.S.
Absolutely.
Or should that get pushed down to the CFCs? I don't think there's a clear answer to that on the model rules.
No, it's not. I mean, also just in general, how do you allocate those taxes under GILTI rules if you do global blending? How do you even allocate then CFC tax to different countries? I think it's quite an interesting one.
Yeah, do you do pro rata based on taxable income?
Exactly. And it's very relevant. If you do pro rata, for example, you might be still potentially under the 15%, and then our UTPR could kick in.
Right.
So this is, and I mean, we'll talk about in a second the filing. That's another topic, because if you then have to do the book minimum tax filing, which is quite different, as I learned from you, Doug.
Right.
And you do the Pillar 2 filing on the UTPR, that's going to be quite complicated just to get the numbers there in the tax return.
Yeah, the complexity for taxpayers in the filing, and we'll get there. But before we get there, and I appreciate, Arne, that you are not an expert in EU law, but maybe just to kind of get your perspective as a German tax advisor, I think many of us were I kind of started with this kind of under the expectation that, well, if we didn't get kind of unanimity in Europe for the directive, which is effectively wholesale implementation of the model rules and the commentary, I'm oversimplifying a little bit. Then there was a bunch of discussion about enhanced cooperation, right? About whether they could get, and I'm not even sure how those rules exactly work, but you effectively need a certain number of EU members to agree to effectively have enhanced cooperation.
Right.
And I think some of that manages some of the potential issues with respect to EU law, on cross-border EU law.
Right.
What changed in Germany, or what is kind of the Germany's kind of view of that?
Right. That's a good question. So, I mean, one, we need to see, of course, that Germany is of the view this is the right way to go. Just to create a level playing field all over, basically. So that's politically something which should be achieved. And therefore, of course, no matter what instrument we can use, if I might say so, in order to encourage other countries to follow this, we will probably try to apply that. So therefore, directive, of course, is the most favored one, so if I might say. And as you might have seen, there are some discussions around, and the outcome is still unresolved. The G5 statement you have seen, and then there might be others kind of initiatives as well. But I think there's one interesting element I just want to allude to very quickly, because in the beginning, when the whole process started, there's also the question about to what extent are those rules in line with the fundamental freedoms, which is primary law. And I think that's probably what you're alluding to.
Yes.
So for the ones who haven't looked at European law, the principle is that discrimination of cross-border situations is not allowed under European law. So what does it mean? It means if you have a set of rules which primarily apply in a cross-border context, you in principle have the question on the table, is this something which is against fundamental freedoms? Now, if you take Germany with a rate of 30%, I think it's fair to assume in most cases it's going to be cross-border situation where those rules will apply, even though, of course, we know, especially for the losses and treatment of deferred taxes, there might be situations where you also have a possibility to apply it within Germany. But I would say the majority of cases are cross-border. Now the question comes up, is this in line with the fundamental freedoms? And I think there, the question to what extent we have a directive is very relevant, because a directive, I think the argument is out there also that you as a member state are forced to implement those rules, which gives you some relief on the discussion of the fundamental freedoms. If now we don't see a directive, I think it's going to be quite interesting to see how this will develop, because then it will be, again, unilateral rules in the end, especially if it's just based on a G5 statement. And then there is also some discussion between tax professionals and university professors to what extent there might be still an overriding principle to say level playing field is now, will be accepted as well under European law. And quite frankly, I think this is at the end something the courts will rule about. But it's interesting to have this in the back of our head, because we're all looking at what's going on politically, but forget about this discussion, which was really something at the starting point when we talked about Pillar 2 rules 3 or 4 years ago, and has been somehow almost forgotten.
Right. One of the things that I'm very interested, particularly, if there's not a directive, I mean, frankly, this is an issue even if there is a directive, as we think about kind of BEPS 1.0, as we think about some of the anti-hybrid rules, for example, is, there seems to be kind of this general view and principle that every country that adopts these rules is going to adopt the exact same set of rules, which is almost kind of required as you start to think about how taxes get allocated, or how that income and ultimately the taxes get allocated across the variety of the various jurisdictions that actually implement these rules. I think if we look back at kind of BEPS 1.0 and the anti-hybrid rules and the CFC rules in Europe, every country kind of adopted a little bit different. And it's going to make things extraordinarily complicated, I think, particularly if we have different jurisdictions implement QDMTTs. Like, what does the filing look like? How practically can that work? And I think it can just create extraordinary complexity for frankly, both advisors and taxpayers as we think about having to make various tweaks to various domestic law, and then understanding how those taxes get allocated, because this really is intended to be a global tax system.
That's the idea. And I mean, we have to also give the credit that there was really the attempt to make those rules, as let's say defined as possible, also as complicated because it's not as possible at the same time. But of course, the attempt was to really have one set of rules which is applied all over the world. But I mean, the reality as we know it, there will be always some deviations simply because of different interpretations.
Right.
Maybe sometimes also where there is, let's say, some room for interpretation, local parliaments will take a different view.
Right.
Because in the end, this is just a framework. But if you go really down to the nitty-gritty details, as we all know, there might be always deviations. And that's, of course, frankly a concern. I mean, it could be only a few % of deviation, but they can, of course, materialize. And then it becomes really interesting, especially when you go to the filing and Doc, this is something Germans
I'm ready
love to
now.
do. So for everyone on the podcast, Doc and I were talking about this for quite some time. And the views, what is important for different countries. And in Germany, we know about these rules for 2 or 3 years already. In most cases, German companies also will expect not to be materially hit simply because we have very stringent CUC rules, which already provide for a taxation. So in Germany right now, the big topic is for a lot of our clients, how do we make sure that we at least provide a accurate tax return? And therefore we have a lot of clients now looking into that. And if you look to these model rules, you see that there are really a lot of deviations. And if you look through the different data points, the big question comes up, how do you make sure that you even get those numbers into your system, into your tax reporting system, on an even global basis? So there's, as you can imagine, is a big challenge. And then the interesting question comes up to the deviations we just talked about. How do you even make sure that the deviations will basically be caught?
Right.
So if you look at those rules right now, how they basically are structured, they basically require you a local kind of filing, basically, as it is right now.
Right.
It's like an information tax return, or so to speak, where you basically just collect all the different data points.
At the ultimate parent entity.
Well, hold a sec. Under these current rules, you actually do it locally as a starting point, and then you can deviate that you say one entity in one country can do the collection and filing for all these entities.
Fair enough.
Option 2 and option 3, that's what you talked about. You do it centrally, for example, in the US, but only under the condition that you have these exchange information agreements in place, which we don't have yet. So we will
have any of this.
Nothing yet. So we will have to see how fast those information agreements will be concluded. Until that point in time, you basically have another local filing requirement in order just to prepare to do a filing at the UPE, at the ultimate parent level.
Right.
So you have to collect all these data points. And then, of course, we have the qualified domestic top-up tax as well, QDMTT, as you mentioned. That's going to be another filing there. So that's going to be also interesting, how any information which are centrally kind of collected, how this involves like a local filing. And last but not least, I think it's going to be interesting how this plays out, because of course, you would say it's easier to do centrally and all prepare that, because then at least you do only one filing, you don't have to go all the world.
Exactly, which I went straight to that option.
Absolutely. Yeah. But the interesting question is then, to your point, there will be deviations. And you have some countries who have very stringent rules, what is required from a filing perspective and penalty rules. To what extent you want it centrally and want to basically trust that you capture all the deviations. It's interesting to see whether taxpayers might take the option, well, for those countries, maybe it's better to do the collection on the ground where really the numbers are sitting and making sure you comply with those rules and then report it up and collect it there. So it's going to be very interesting to see which kind of direction this goes. But I can certainly say this is going to be, let's say, really an interesting exercise, which we have all in front of us and which will take a lot of efforts, I guess, on all sides.
Yeah, one question I should have asked earlier that I didn't, because you had mentioned the QDMTT.
Right.
Do you anticipate Germany implementing the QDMTT?
Absolutely. Yeah.
It feels like almost any country is going to be adopting this. I kind of feel that's inevitable. Yeah. Do you think that would be sort of in the same timeline as the UTPR or as the IIR, or?
I honestly, I do not know.
Okay.
Anticipation is also, it should be somehow aligned. I mean, I don't see any reason why you would do this on a later point in time, but that's pure speculation.
Yeah, makes sense.
Sure.
All right, so going back to the compliance part, and you and I have had a bunch of conversations over the course of the many months and last couple of years on kind of the difference between kind of what some of the German taxpayers and U.S. taxpayers, kind of their approach to Pillar 2.
Right.
Whereas you had mentioned that a lot of the German taxpayers are starting with, how are we going to comply with this?
Yes.
Right. And I think a number of the U.S. taxpayers are starting with, well, how much tax are we going to owe? And to your point, because of GILTI blending, right, with it's still very possible for U.S. multinational to have low tax CFCs and higher tax CFCs, and still may not even pay any GILTI tax because of the way blending works. But I think what we've learned is that regardless of whether you start with the modeling or start with the compliance, kind of all roads lead to the how are we going to get the data in the form that we need to actually do these calculations, and so whether the driver is, well, we want to comply, or the driver is, we want to know how much tax are we going to owe, it starts with this, what I've referred to on the podcast as operational readiness.
Yes.
Like, do we have the right stakeholders, accountants, tax accountants, our finance people, the systems people? Because this is effectively a new set of books that companies are going, that it does not really exist. Right, kind of by constituent entity, and if you're German paired, presumably it's IFRS or German GAAP. For U.S. companies, it's U.S. GAAP, but they do not, for the most part of the companies that I've talked to, have that system. And so it's kind of been interesting to me that culturally, kind of where we started, but we all end up with this, holy cow, we have a lot of data that needs to be collected and formed to be able to do these calculations or comply.
No, that's definitely a difference. Maybe you can say culture. We Germans, we like to file and stamp it very accurately, very fast. So that's how we are. I don't know. Or maybe it's also just to actually also see that in Germany, most people anticipate not to pay really an extra tax because of the rules.
Because of the way your CFC rules are structured.
So therefore, maybe we're skipping this one step, maybe, and I mean, ultimately, it will all go to a tax filing, basically. And I think that's what you see. Also, you need to bear in mind, in Germany, we're hearing about this for the last 2 years, as it's, as I said, a topic which is really encouraged in Germany. You've heard it in conferences again and again by representatives of the Ministry of Finance, public conferences. So everyone is kind of anticipating that. So everyone is, okay, we really need to get this done. So there's really not a question at this stage that it might not pass. I mean, of course, you never know nowadays.
Of course,
we have energy crisis in Europe. There's always something you never 100% know. But I still would say, given the fact that in the summit where we talked about support in Germany for the companies from energy crisis suffering, the question about how do you finance that was brought up, and also this Pillar 2 rules are being seen as one element of that. As
a way to actually increase potential corporate tax collections.
Of course, leaving aside how much taxes will be re-levied in the end, but of course, politically it's something which is part of it. So therefore, so definitely it's something which we see a lot, and we see a lot of German clients who are now in the process already, looking into the books, looking how do they get the data points. So I think we're probably really one of the first countries very early on where taxpayers looked into that just to get ready, basically. And
And the other comment that I would make from talking to a number of different taxpayers around the world is that there is more consistency with the systems that Germany uses, as well as your provisioning software, than what I've seen throughout the rest of the world. In other words, like the ERP systems can be a lot more disparate. And now, of course, it depends obviously on the taxpayer, but I just think that there's been just more I've seen more consistency in Germany than I have, for example, in the U.S., where you can sometimes have a dozen different ERP systems. And if you've done a lot of deals or whatever, I'm sure it's still a challenge in Germany and the U.S. or wherever.
Exactly, that's what it is. I mean, it depends on each taxpayer. But I mean, I think there are certain taxpayers who use already technology yet at this point in time to your tax returns, and that's something you can leverage upon. But maybe it's a good starting point to even consolidate.
Absolutely. All right, so let's move on to another topic that I know you're exhausted talking about. I think we had like a 50-minute podcast almost 2 years ago on Section 4.
Was it 50 minutes?
It was 50 minutes. I went back and looked before this. I was like, I'm not sure what we talked about. I did not go back and re-listen to it. But for listeners that are interested in more detail, we give the whole kind of gory history of it and where we are. Where are we now? We're almost 2 years later. Maybe if you could just remind listeners briefly, what is Section 49 and kind of where are we?
So I'm trying to make the 50 minutes into at least a minute or two, just to summarize it all. So what we have this provision which basically provides for a taxation even if transactions occur outside of Germany. So let's say a payment going for royalties between two taxpayers who are not residing in Germany can trigger German withholding tax. And you might ask us how is this even possible, rightfully. The reason is that the German tax code foresees once there's a registration for some IP, for patents or for trademarks in the German register, the German tax code foresees that this is subject to withholding tax. Or if you sell off the IP, you can also be subject to tax in Germany and do a tax filing and subject to a tax. So this
I will just to interrupt there. Remind listeners that the U.S. rule for sourcing for royalties is based on where the IP is used, and so the U.S. rule arguably is similar because you could have a payment between two non-U.S. companies, but if it relates to IP that is used in the U.S., that is a U.S. source payment that could potentially be subject to withholding tax. As odd as I think that struck many taxpayers and advisors, frankly, the rule is very consistent with how the U.S. sourcing rule works.
That's a good point. And by the way, also use is also another option. I just left it out in Germany. Registered or being used in Germany. So basically, this has been out there, and we have a lot of guidance on this as well. The German Ministry of Finance made it clear because there was some uncertainty. How do they see this? Because it became as a surprise when the discussion started. They made it clear, this is how we see it, as I just laid it out. And then afterwards, we also had some, let's say, administrative guidance, how you can make the procedure to declare and comply with law a bit easier, because not everyone anticipated the rule to be read like that. And then the question comes up, how do you do this if you make those two payments between two treaty countries? So it could be even between two U.S. entities. Because we have a double tax treaty between Germany and U.S., and we were not allowed to basically tax it. However, in order to apply the treaty, we have a procedure which is kind of formalistic. We need to apply for basically for a certificate, which basically makes the statement that you're entitled under the treaty. If you don't have that, you would actually first have to pay it and refund it. And then, of course, as you can imagine, that's a lot of, let's say, crunching numbers and filings without any tax being levied.
And sometimes a big check that taxpayers would have to write to know that they could then get the refund.
Exactly. In order to basically streamline that, the Ministry of Finance already provided for a decree. It was last year where they basically stated there's a simplified procedure within a certain time limit, which has been extended again and again, which allows for the past to have a streamlined process where those certificates were not in hand. And I think it's really recommendable to use this procedure because otherwise, on the normal procedure, we have to pay and refund, and which obviously is much more burdensome. So that has been there already. And now we have a new law which is pending where there's also a suggestion to modify that. And the modification basically foresees that those rules are not applicable to payments to third parties because until the current rules, there was no distinguishment whether this payment is between related parties or third parties. And as you can imagine, that becomes very hard, because those third parties are not even aware of those provisions. And I can tell you, we have clients and we have taxpayers who basically, trying to apply those rules. And it's not always easy because your counterparty might be not aware of it. But I can also share that this is something which is happening in reality. So you see that in reality, really people follow those rules to a certain part. But there's a lot of taxpayers also where there's a problem simply because of the numbers of taxpayers involved and the third parties being involved just to even apply that. And because I think there's an acknowledgement that it's too hard to administer. And in most cases, anyhow, just a filing and the taxes will be repaid. There's a suggestion to abolish that. And then there are some certain other rules in the future to also make this more, applied and more, let's say, concentrated view. Only to territories which are defined under a very special law provision, like third countries where there's no collaboration. There's a bunch of, also other countries which are still covered by a special tax act. And from next year on, 23 on, those provisions will be only applicable for those countries if those will pass parliament. But again, that's still subject to discussions.
All right. So I think the short story is this has not gone away. I think there was some speculation in the tax press and elsewhere that maybe this could just get repealed and that obviously has not happened. So it's important that taxpayers understand.
Look into it, for sure.
Need to look into it. And because particularly of the penalties, to your point on Pillar 2, that they can be significant in Germany. So it's important that taxpayers still keep their eye on this.
I think it's a matter to keep your eyes on it, especially for the past and the future. There might be some more focused application, but it's certainly something to be recommended to look through. And it's not suddenly disappearing as a whole, as a topic, even though hopefully becomes more pragmatic then after those changes are being implemented.
Okay, so maybe we'll end things on the anti-hybrid rules, and this might even be more challenging to try to summarize in 2 minutes than the Section 49. But we're waiting on some decrees related to the anti-hybrid rules, which arguably Germany was a little late to the party in getting after the EU directive and getting these rules finalized. And it's created, frankly, a whole bunch of complexity, as particularly for U.S. multinationals, where you have disregarded entities in your structure, and if you have consolidated groups with disregarded entities, just lots of complications and questions in how to apply those rules. So maybe what can we expect here in kind of the near term on the German anti-hybrid rules?
Sure. So we expect a decree on that, which is our guidance, how the fiscal authorities will apply for it. It was just a public event where it was mentioned that they're working on this right now, and it's also expected maybe even this year that there will be some guidance. And this guidance is really required because a lot of questions are out there. I'm just going to pick on 2 or 3 topics just to make it not overly complicated. As said by you, these rules are so wide that we can probably talk about this next 2 hours, basically. But I think one big question is, you need to be aware that our definition, what is a hybrid expense, is much wider than most countries. So if you have other countries where you just look at payments, we also think any kind of other expense can fall under it. So costs for any kind of goods which are sold can fall under it, depreciation can fall under it. If it's an intergroup acquisition is basically happening before, and there's no non-taxation because of a qualification conflict, any of those expenses can be caught by those rules. And then the other thing is also when you look at the imported hybrid mismatch rules, also the definition when you basically link like an income and an expense is quite wide. So therefore, there is a fear so far that we say any kind of expense in the group, which ultimately leads to income which goes back to Germany, which leads to expense in Germany, can lead to a potential imported hybrid mismatch rules. So it's going to be really interesting to see whether there will be some reading down and narrowing it down that we say there needs some more connection economically between those hybrid expenses, any kind of payments going out of Germany. If not, as you can imagine, it's going to get very complicated. Because assume you have a payment going from Germany somewhere to a European entity, from Europe to the US. You will basically have the whole US group scan, is there any kind of hybrid expense or double deduction expense.
And where we have our disregarded entity, I mean, that gets really complicated.
It's going to be really complicated. So it's going to be interesting what the guidance will provide on this one. Also, we expect how the GILTI rules will also be applied in this, and the double deduction scenarios especially. We expect, interesting how we're going to apply that.
Because we haven't seen a lot outside from other countries on how those GILTI taxes and the GILTI rules apply in the context of anti-hybrid. So we'll be interested to see that.
Very interesting. And then last but not least, documentation. What is required from documentation? Because in Germany, how it works, there is the requirement for taxpayer of enhanced cooperation in cross-border scenarios, which means you need to basically, at least if you have an indication that these rules are applicable, you need to make an effort to explore to what extent you're subject to those rules. And the interesting question is, what does it mean? Now, do you just basically ask in your tax group, hey, do we have any indication that there's any hybrid, payments basically which are allocated to Germany? Is this enough? Do you need to elaborate more? Do you need only at the entity which you're paying to? Do you need to look at the group level? What is the requitation required? And last but not least, don't forget about collaboration clauses. What happens if you have an intra-loan group agreement? Do you need to have a collaboration clause which allows you to ask those questions? Because a lot of times you might ask the question, but you don't get an answer. So is there a requirement to have this in your agreement to comply with these rules? Because if you don't comply with the rules, the tax authority at some point in time might make the statement, okay, you have not complied, I'm assuming the negative towards you, I'm assuming the rules are applicable and I'm denying the deduction. So that's going to be very interesting what the position will be there and to what extent taxpayers need to prepare also down the road in order to prevent that those rules apply just because of formalistic reasons actually.
Got it. Well, we'll keep an eye on that. So. Man, a lot covered, Arne. Thank you very much. I think the common theme is just, there's just a lot of compliance and obligations for taxpayers to think about. And so we'll continue to keep an eye on Pillar 2. We'll continue to keep an eye on Section 49 as well as the anti-hybrid rules. But thanks for joining.
Thanks for having me.
All right. So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Arne Schnitger, PwC Germany International Tax Partner, and host of the podcast called
Frisch Serviert.
Frisch Serviert. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.